So today we have the honor of having Greg Crabtree in the room with us. We were introduced to Greg. So Greg, actually, I don't know if this was communicated to you, but we came across your information from Jay Kinder and Mike Reese. That was the connection that we initially made. Read the book, loved the content, reached out. We're actually having Greg speak at a mastermind that we are doing in July, a mastermind for property managers that are really committed to growth. And in that process of growth, want to make sure that their house is actually in order. And Greg, one of the reasons that we love your content is that we're very much focused on sales marketing. We talk about it all day long. It's our bread and butter. But we love where you're coming from of making sure that the house is actually in order so that you're not amplifying through growth something that's broken. It's kind of like a first order, first principle sort of thing. So as we're getting the slides here set up and Alex is taking care of that, Greg, can you just give us a brief background and context for where you're coming from, how you got into the business, how you ended up doing what you're doing?
Yeah, so, it really kind of came from, I would consider myself a frustrated accountant because, it's one of those things that as I talk to my entrepreneur friends, they all kind of would poke us a little bit as a profession saying, well, you guys are selling me what you do, but that's not really what I need. And so I joined a group called the Entrepreneurs Organization back in 2001, and the way our forum concepts work there, the 9 other people in my forum with me, I was not allowed to do business with them. So it was designed in a way to create, kind of confidentiality, sharing, and lack of conflict of interest. And so I took those 9 people to become my focus group because they were 9 people I wanted to do business with if it was available. And what they told me was, as an accountant, one, nobody likes the April 15th surprise, so that's the first thing to fix. Secondly, we want to we'd like to pay on a fixed price basis because nobody likes paying by the hour. But the third piece was the damning indictment, I think, of our profession in the sense that, hey, you see hundreds of people's most intimate details. You have some idea what works and what doesn't. And really what it comes down to is when you're teaching accountants in college, about what they need to know, and even in the work environment, we're not taught to believe anything. We're taught to just report on data. And I think that's fundamentally flawed. So I did a study of our clients' data that I didn't get paid anything to do. I just took 50 of our clients' data and created a lot of the concepts that we use in simple numbers because, I had to create a common language of data sharing. And these are 50 companies that are in totally different industries. And the thing is everybody that's on the call today, if they pulled out their P&L and shared it with each other, everybody's P&L would look different. And we go, why is that? I mean, why aren't we talking the same language? And so we developed a simple numbers model to create a common language protocol for people to see their data, understand how their business engine works. And, we've got high margin businesses, there's low margin businesses, there's labor oriented businesses, there's people that sell product. But amazingly enough, and I'm hesitant, I'm not going to say that I created a simple numbers model, I discovered it. In the sense that there's a way that you really look at business data in a simplified format that applies to every business regardless of model, to where you can understand where do you really make your money, and is direct labor being profitable and productive, and is management labor above all being profitable and productive. And I think we scare a lot of people to death when we say we've come up with a way to really hold management labor accountable to being productive. Because it's not a common thing that people think of as holding management accountable to being productive because they don't know how to measure it in that process.
Well, so I could certainly see that being amplified in the context of small businesses where the management layer is thin. And to some degree, you're talking about a little bit of a self-indictment and personal accountability is really what you're talking about.
Exactly. But see, you've got to have a framework to actually look at it, understand it, and report on it. And so as I've come to believe, at this point in my career, I'm far more of a behavioral economist than I am an accountant. Because really what our firm is designed to do is really help people look at and create and report on compelling data that changes behavior. Because if the data doesn't change behavior, what's it good for? I mean, I needed to file a tax return. I might need it to send to the bank. Those are so low on the bar of what's needed in terms of data to manage by. I mean, it's just not even funny, because most of it is so old, so stale, and so uninterpretable that, you know, it's not going to help you run your business. And so, you know, what we really love is take somebody that, you know, there's probably 5-10% of the entrepreneur marketplace that person truly understands business from a gut level, and they just know how to make things work. Well, I mean, we do have some of those people, and I get to work with them and I study them, but the vast majority of entrepreneurs, they have something that they're really good at, but the rest of it is foreign to them. And so what we try to do is surround them with a data set and a tracking of information, so that they now have almost the same quality of gut level instinct, because they're seeing data that's relevant, that tells them, you know, here's the thing I need to do, you know, to make my business work correctly. And a lot of times, I mean, it's just amazing how off base somebody is of worrying about something that feels like it's holding their business back. And it's just a rounding error compared to the real thing that's holding them back. So really the first thing in the process, to us, there's 4 simple rules to setting up your business to really fix it. And it applies, like I said, it doesn't matter what industry you're in. The first thing is you want to remove distortions from the business. And the classic distortive element in business is the fact that it comes in 2 things: owner compensation and related party transactions. And so in most businesses, the big one is owner compensation. And so the real simple discussion is this: if you got run over by the bus going home today and somebody had to be hired to replace you to do your job every day at the business, what would that person be paid? And so too many times in all these businesses, we think from a tax mentality instead of an economic mentality of what should that be. Because if I don't pay myself a market-based wage for the job that I'm doing in the business, my net income is immediately distorted. And so I'm not looking at economic truth. And I'm a big believer that the best entrepreneurs in the world understand economic truth, and that's what drives their decisions, not some fantasy number that we can make a journal entry and fix this or fix that, or you know, if you've got to play mental Olympics to figure out what true net income is, you know, you're really holding your business back, you know, in that regard. So that's the first thing. And so the thing is you could either be high or low. We have clients that they're trying to draw a salary out of their business, but they're really trying to let everybody else do the work. And if they didn't show up for 2 weeks, nobody would miss them. Well, that's a person that's being overpaid. But most of the time, you've got people that are trying to not take a salary or take as low a salary as they can, avoid the payroll tax implications on it, and then they're taking distributions out of the business. And so the reality there is, you know, one of the things I always caution people is the fact that I want you to bake that salary into your operating profit numbers, because you're looking at what you really have to produce to, and you're holding yourself accountable. Are you producing to that number? And then the idea is I get paid a salary for what I do. I get a return on what I own. I think the biggest mistake that entrepreneurs have is they do not look at their business for a return on invested capital basis. I actually got to chair an executive education event at Wharton Business School last week, and so you know, it's funny. I grew up on a chicken farm, so it's kind of interesting. They let a chicken farmer, you know, share the stage with some real PhDs,
right?
Wharton, but it was nice. You know, I even got to teach the professors a thing or two. You know, so. But there again, one of the professors, David Wessels, who's really a strong background on business value, and it's a you know, thing that ultimately what we're trying to do is create a business of value. Whether we sell it or not is irrelevant. That business has to be valuable, and it really is about the return on invested capital. And I think one of the missing pieces that we all have in our understanding of privately held business is the capital that's required to put into a business and then grow it to a sustainable level. So if you really think about capital from a standpoint, there's really 4 things that affect capital. I put money in, I take money out, I add profit, I lose money. And so, you know, forget about all those accounts on the balance sheet, that sheet that nobody ever looks at on your financials. But, you know, the accountants put a bunch of accounts down there, but those are the only 4 things that really happen. And most everybody on the call, I guarantee you, didn't put any money in their business. They started with $2 bills that they rubbed together to get the next one. And so the idea is you're really trying to understand, I've got to create capital in my business. And then what is the expected return on that capital that I need to get out of it for it to be a successful small business? Well, our study of our client data tells it's a screaming number to us. The minimum return on investment capital that you should get as a privately held business is 50% year over year without selling the business. And really, most of our clients have closer to 100% year over year.
Oh, so pausing on that, Greg, return on capital, what is the norm outside of the small business context where that is actually a number people are focusing at it, larger corporations, what's the range of what's an acceptable return there?
Public companies are probably going to accept somewhere in the 20 to 25% range, but they would like higher. And once you get them large publicly held businesses, they have a lot of them are using leverage. But really at the end of the day, they're going to accept probably 25%, is probably a good range. But as a privately held business, you can't cheat the marketplace and get immediate liquidity at a moment's notice like a public company can. And so therefore, private companies need a much higher return on investment capital. And so the story I like to tell is we had a client last year that was selling their business, and I like to refer to this as my $20 million hour. So the client walked in and he was going to sell his business for $40 million. So he was doing $5,250,000 a year in profit, not revenue, profit. And he had $5 million of equity. Now, he started with us 15 years ago, started his business, and he did this. He had $2 bills he was rubbing together, and he kept putting profit. He left the after-tax profits in the business because you can't be the business of his size without leaving money. You got to have self-funding. So at $5 million of equity, he had his appropriate core capital target of cash. He didn't have any debt. He owned his own inventory. Great business. He'd hired a really expensive, private capital firm to represent him. He had 10 offers, all at this $40 million price. And so they felt like, okay, well, this is market. And he comes to see me, and I said, I'm thinking about selling. I said, well, I understand that. This is, but it's not enough. He goes, what? It's $40 million. And I said, no, it's not enough. And here's why. So if you take $40 million minus the tax implications on that, you're going to be capital gain tax on most of it. So he's going to clear $30 million in after-tax funds. And I said, here's the one question you got to ask yourself. Where can you go invest $30 million that makes you $5,250,000 a year that's legal?
Right. That's legal.
That's the essential question that we have to really discuss, because that's a 17.7% rate of return. And I said, it's possible. You're not going to get it in the public markets, and
that's hedge fund type returns, right? You're embracing a fair bit of risk.
Exactly. So I said, listen, you got a great business, you got a great management team. And he says, I don't know, I'm tired. I says, tired? I said, you work 15 hours a week and 14 of those are not in the office. I'm not buying the tired thing. I said, you might be worried about the future, but he was in a really good industry that wasn't going away anytime soon. So I said, it's your decision. You just think about it. So after about an hour-long discussion, the thing we talked about is, I said, well, just go home and think about it. So a week later, he comes back and he says, well, I got him up to 60 million. I said, okay,
oh, wow.
Yeah, that's a 10% replacement return at that level. And I said, okay.
So you're saying same buyer, the number goes up just because he had more leverage by knowing what the opportunity was really worth.
He could say no because he understood value. Right. Yeah. And so to a large degree, he understood real value. He understood real profitability because he was getting a salary out of the business. That $5,250,000 a year, the business might have needed a couple $100,000 more a year. So he'd pay about $2 million a year in tax, and he had $3 million. He could do anything he wanted to with it. Because here's the idea, and this guy never fell prey to this, is he always lived off of his salary. And so the idea is the moment that you are living off of the profits of the business, you are heading down a slippery slope to hell, because The business is not always going to be profitable. There's 1 out of 5 years, market conditions are just going to hand you a raspberry and it's just not going to work out. And so I can guarantee you probably 95+% of the time you'll always get your salary. But to always have profitability, well, that's a little questionable. So if you need your profits to consume to meet your lifestyle needs, you know, if that year that it doesn't produce, where do you get it from? Well, guess what? You only got 1 cow of milk. It's called your business. And so you reach into the business's debt structure to extract money for you to personally consume. That business debt structure is there to run the business, not to meet your personal consumption needs. And everybody just gets it all jumbled up in their head. And so, but at the end of the day, that's the only source there is. And that's where a person digs a hole, and then it's 2 to 3 times longer for you to dig out of that hole. Whereas if you really just set the expectations, and this gets back to the behavioral economics idea of it, you know, when you set a clear target that people understand, humans have amazing capacity to perform to that level. I mean, you know, you go back to the 4-minute mile. I mean, people thought that it was humanly impossible to not produce at the 4-minute mile until somebody did. And then it's a regular occurrence now. And the day that Robert J. Bannister broke the 4-minute mile barrier, there were actually 2 people that broke it. They just don't ever remember this guy who came in second. And so it becomes an ordinary thing. Well, I believe it's the same way in terms of business profitability and human productivity. You know, once you set those targeted levels for each business model, then it gets down to kind of what I kind of came up with this real simple thing of saying, well, you know, if you really want to be successful in business, it really only takes 3 things. You got to figure out what the market needs, find a way to do it profitably, and then tell everybody about it. I mean, I said it was simple.
Basic formula, yeah.
I didn't say it was easy, but I said it is simple. And I think for the vast majority of things, even for people that are in the, you know, property management business or any other business, you get caught up in selling people the thing that you do rather than doing what the market needs. And I think what we do as a firm now is a pure example of that, figuring out what the market needs and then finding a way to do it profitably. And we kind of don't want to tell too many people about it because it'll blow out all the capacity. We're adding people as fast as we can. You know, but it really happened in that sequence, because once we figured out what the entrepreneurial community was starving for, it took some experimentation to figure out if we could deliver that service in a way that worked, and can we keep training people to think in that way, because it doesn't come naturally out of their collegiate experience or their work experience, but it applies to everybody.
Love it. Yeah, totally makes sense. So just out of curiosity, do you think of what you do as, would you put it in the category of productized services as opposed to a traditional service? Okay, great. Absolutely. Because, you know, realistically, so think of it like this. When you bill by the hour, it is the lowest form of economic transfer that you can have, because you know, if I bill by the hour, I'm giving away my expertise and charging for my ignorance. It's one of those 2 outcomes. I almost never get it at market. And today, the only thing that we do on an hourly basis is outsource bookkeeping, because really I'm renting a body. But if I could find a way to control the scope, I would bill for it on a fixed price basis, because I want to create an incentive to work at a better productivity rate. So the reason that that's interesting to me is because we're taking a vanilla service, a vanilla industry, accounting, right? Excitement, kind of sexiness level of that, low. What we're doing, though, is you're layering
it's lower. It's the section is lower than low. So,
it's dragging along the bottom. Yeah,
that's right.
Absolutely.
But
by layering on that expertise factor, that value-added layer, it completely changes the dynamic, which applies to, fair to say that applies to any service-based industry. Property management, for example, it could be a low-margin commodified business, or it could be something where you're viewed as the most trusted advisor, and from there you have a position of having an exciting business.
So the idea is you can take any service offering and break it down into its components. And so when we look at our business model, it starts with consulting. If somebody doesn't buy our consulting services, we won't deploy our tax and outsourcing team to support them, because we only want those teams to work with people who want to create a planned outcome. So if you don't want to create a planned outcome, I mean, I don't want you to be a random problem, because you're going to be a random problem on Friday afternoon when I want to be on the golf course. So sorry about that. I mean, because let's face it, if we can create planned occurrences, in this process, all of us can live a much more productive life. So,
sure.
And then granted, if I have a client call me at midnight and has a true emergency, I'll jump out of bed and do whatever they need, because that's a true emergency. But when all of us are living our lives based on somebody's just random problems because they didn't plan, poor planning on your part doesn't make an emergency on my part, unless, you're one of those people we've got that deep relationship with. And let's face it, we're all human. Sometimes we don't plan for something, but it wasn't because we weren't trying. That's a whole different thing. And I think every business model, like even property management, would be one of those where what the property owner needs is a consultative strategy first. I mean, so
right.
we have a couple of I call them my real estate entrepreneur clients. So I've got 4 or 5 of these guys that are in the real estate industry that the goal is they're trying to run an operational real estate business in reality, and
Mm-hmm.
so there's that strategic component of how do I optimize this property and optimize my return on investment? And some of the guys are buy and hold and manage the deal. Some of them are buy fixer-uppers, get it up to acceptable rental rate, and then flip the property and reinvest that capital to the next deal. I mean, all of those strategies work, but they all have their different issues in terms of, if you're a flipper, well, there's only so many flip properties available at any given point in time, and it depends on the collision of the demand of, can I buy those right? Right now, there's tons of liquidity in the marketplace for funding deals, so that's not a barrier as it once was, several years ago. And there's even a good bit of non-recourse money right now that makes it a really compelling, deal, to finance a piece of property, in that regard. But otherwise, it's still the other thing of then going into the operational mode of saying, well, what is the real economics? And so this is kind of a case where I refer to it as the management basis of accounting instead of GAAP. Generally accepted accounting principles, I'm telling you, they don't produce truth. I mean, they have a point. They have a need in the marketplace. I get that. But from the entrepreneur's perspective, you can do anything you want to do with your data to make sense to you. That is the highest level of value. And so I call that the management basis of accounting. We had one client one time in a different industry, but he wanted cash basis revenue and he wanted accrual basis expenses. And I'm thinking, what? And then it turns out, it's really brilliant, because the way he looked at it is when we committed to pay for something, he was committed, but he couldn't spend the money until he collected it. And he had an issue of a really long cycle time on his collections, to where he wanted his people to understand, you don't get any credit for this until the cash comes through the door. So let's talk about how to reduce our cycle days from 125 to 60. And that they literally cut it in half by that plan.
So what I hear you saying is you're working with the data with a context or an outcome in mind, and then making the numbers work for you by framing them around a meaningful issue, as opposed to just the numbers and the raw data in and of itself is supposed to have a perspective, which it doesn't.
Yeah, exactly. And so I'll tell you that story to say, if I was working with a property manager, most of our property managers, we actually treat principal payments as an expense, and from an accounting standpoint. Well, it's not GAAP. I mean, and there are some variations in terms of what property I might have leveraged versus properties I didn't. But really, from a property standpoint, I'm thinking more cash flow, but I'm kind of mixing a little bit of cash flow and profitability in my mindset as a return on investment kind of mindset. And realistically, to me, that I'm fine with that, because any accountant worth their salt can take a alternative presentation like that, and if I need to prepare a tax return or produce a financial statement based on generally accepted accounting principles, you make some adjustments and produce the statement. It's better to do a one-off of that presentation than to mess up my running data in terms of how I truly see it. And I will guarantee you, almost every person in real estate thinks of their principal payment as an expense. I mean, it's just how their mind works. And it's like, well, I'm okay with that. I mean, that doesn't freak me out as an accountant. I can account for that way. and I can have the best of both worlds, because most of the time you really don't have a whole lot of gap, financial statement presentations to third parties. You're not running a REIT, to where you do have to stick to that. And basically, I've looked at some REIT financials, and they're you got to really know what you're looking at to even make sense out of those guys, because they love to play games with you. In terms of, it's really amazing. I get to look at a REIT's data because a client of mine is deeply involved in it, and so she sends me the financial statements to look at and to help her interpret them, and it's kind of scary how they figure out cash flow to be able to pay out as a dividend when they're not really making any real money. And and that's something that doesn't last forever. And I think that's really where every entrepreneur needs to understand, where is the source of that profit, what makes sense to you, and then how do you know how to tweak it, optimize it, and make it work better. Classic example is, I'm not a fan of looking at occupancy rates in the property management world as a number of unit percentage. I want to look at it from an economic standpoint, because everybody will give a discount to fill up a unit, sometimes. Well, but that unit still has some negative occupancy, because I'm not renting it at the optimal market rate that unit should rent for. So to tell myself that I'm 100% full, I'm not 100% full. Every unit is occupied, but I have 5 units that are 15% below market. So I technically have, maybe I'm only 93% occupied. Wow. And because that's the way you've got to think. And one of the best managers, one of my clients in Cincinnati, he is probably one of the best at really studying the market and knowing. We have a very complex forecast model that we run with him every month, where we take every property, every unit of every property, and we're forecasting the future and looking back at past performance. And he knows, what are the future rents where that particular unit is going to come up for renewal, and what should that new rent rate, move up to be, to stay relevant with the current market. Because as you start to move up to market, and this is depending on where your units are right now in the marketplace, there's some hot markets that have no room for additional capacity. They are landlocked. There's no real optimal way for somebody economically to create more units, and yet there's demand. Well, that's where you better be getting your maximum rental value out of. Otherwise, if I'm in another market where I got a new complex going up right next to me, and there's plenty of land available, and it's probably questionable as whether or not we have enough population. Well, I got to be looking at it at the other direction. How sensitive can I go on the low end before this property becomes unviable until we catch up to over demand or oversupply in the market, and demand catches up?
Totally makes sense.
Yeah.
Totally makes sense. Two questions, Greg. I want to keep us moving here. I want to zoom in on 2 questions. First question is, how do I know what my profit margin in my business should be? Second question, how do I know how much I should be paying my staff in various roles? Help us dissect these 2 questions.
Sure. Yeah. And so the idea in margin is you have to look at it and say, so we break down margin in a way that we go, obviously revenue is revenue, so that's pretty straightforward. Do I have any directly associated cost? So that's the first thing that we want to filter out and say, these are costs that, it's almost like a subtraction from revenue, because it goes to somebody outside. So in most business models, so let's take the most extreme. So if I'm a construction company, in my simple numbers book, I use an example of a $20 million construction firm, and between materials and subcontractors, those are cost of goods sold. Those are direct costs. After that, they only have $2,850,000 in gross margin left over. Well, they're really a $2,850,000 business. They're not a $20 million business, because they didn't make the materials. They don't do the things the sub does. They actually just get paid to manage those resources. And so the idea is, if you're at a high or a low gross margin business like that, you really want to think of yourself as that smaller gross margin as your true top line, and then work down from there, because every business looks very similar from there down. Certainly like in the property management world, I mean, you're not going to have probably much in the way, we wouldn't classify much of that in the way as a direct cost, so you're going to have a fairly clean revenue. Now, but here's the thing, is so then you want to look at, well, so based on that, I want to identify, what is my labor cost, and we always want to keep labor separate from other types of costs, because it's the relationship of labor to revenue or to gross margin is really the true productive engine, what that business is able to produce. So from that standpoint, that develops what we call the direct labor efficiency ratio. And so our work in some of the real estate industries, and if you're doing, so real estate agencies, we look at their agents as direct labor, even though they're, and we don't get caught up on whether or not somebody's a 1099 person or a W-2, because sometimes some industries, it's just in the nature of the industry, you're allowed to pay that way. But we created a model in the real estate industry for those guys to where we proved that it was actually better, more productive to have an agent start hiring employees to work with them to service a broader base of business than to do the split commission model. Because ultimately, if you really think about it, if you split a commission, if you really look at the actual services that an agent would provide for that half of the commission, you're almost overpaying for the value of what's being done. Now, it's convenient because I don't have to pay that person when they're not doing anything. And so that's kind of how the agency kind of came up. And this, and like I said, this is relative to any business model. And so the idea is when you're starting off, you'll do a lot of those split deals and you're only paying people when you use them, but you're always overpaying for them. Once you get to a certain size level in any business model and you can really do things yourself, you can start to fractionalize everything that's done and get the right labor level and the right person that's really good at the one component. And so, there's an overarching agent that is got the name presence. They're really the marketing person, so to speak. And then you got a person that'll take somebody around and show them homes. And then you've got another admin person that's making sure all the details are moving along pace to get that home closed, the mortgage done, and all those things. Well, those are three totally different skill sets. To think that one person is world-class in all three of those areas is just ludicrous.
Sure.
And so that's really where size of any business activity allows you to really look at having people that are really good at the very thing that you need done. And now the secondary challenge is going to be, can you make that job, thrilling, exciting, rewarding, and I think in most businesses you probably can. And many times it's really better that person is doing the one thing they really do best and they feel good about it versus asking them to do something they really feel less than adequate.
So yeah, so this is a really hot topic in property management, departmentalization versus a portfolio model. Do you have 10 property managers that each manage a portfolio of 100 properties and do everything, or do you heavily departmentalize? You're talking about the labor efficiency associated with having a specialist do a job, but parallel with that is also the benefit of when you componentize and you departmentalize like that, you can have clearer benchmarks for performance and pay. So talk to us a little bit about how labor efficiency relates to that. Yeah,
so the idea is whatever that margin output of whatever business you're doing, that's the numerator of the equation, and whatever that person makes, the denominator. And so those of you that are challenged with fractions, numerator is the number on top, denominator is the number on the bottom. And so if let's say if I produce $200,000 of margin and my labor cost is $100,000, I have a 2 labor efficiency ratio. So for every dollar I'm being paid, I'm producing $2 of margin, and the net of those two is $100,000, left over that then goes to cover overhead and profits or whatever. And so the idea is it is a way to determine, is that number getting more efficient or less efficient? So if I start off as a 2 and I drift down to a 1.8, well, is it because I'm doing the same amount of volume and that person keeps getting raises? Well, that doesn't work.
Sure.
That doesn't work. The other thing that we see quite often is we get a person that does phenomenal stuff and you're feeling really good. Oh yeah, Mary's doing a great job and we just love her. Let's give her a raise. So you give them a raise.
Yeah.
Oh, they're feeling so good. And then they settle back down into normal performance. And so I've given a raise and now they're performing at a lower rate. And I'm sure nobody on this call has ever had that happen. But unfortunately, we've seen that quite a lot. And so the idea is, see, a body, all of these ideas that we've had in labor management that's just so wrong is this idea of you measure things by bodies. And it's like, listen, none of us are equal when it comes to human productivity. We're all different. And so the idea is what you're really trying to aim for is what is common is $1 of labor. $1 of labor is $1 of labor. What did I get for that deployment of $1 of labor? And that's the multiplier effect that I've got to have to create profitability in a business. And so the idea is as I deploy more dollars, I should get the same resonant rate of productivity out of it. And so the idea is it's really simple. When I tell my team, you want a raise, help me find a way for you to produce more. And I'm happy to give you a raise. But I can't give you a raise if we're producing the same or less. Unless, you might end up having to give a raise somehow, in terms of from market demand. But generally, if there's market pressure on giving raises, you should have an opportunity to be raising prices because there's demand for those kinds of things. Otherwise, there's an occasion that you might have just really caught a deal and caught somebody at a really cheap rate and they finally realize that they're underpaid. But we use a lot of, almost every one of our clients, we'll put wage surveys, for what is the market wage. And so the way that we create a moral high ground here is we say, listen, I'm willing to pay you a market-based wage because here's what the survey says market is. But I need market performance. And as long as I get market performance for market wage, we're both going to be happy. But what I can't do is pay a market wage and get less than market performance. And conversely, I can't create a sustainable model of paying below a market wage and getting above market performance because, that's a unicorn. That happens every now and then, but not often. Now, the other thing we do see, though, is so if you're in an industry that, is more of a learned skill, there are some basic skills that you want to have, but essentially there's not a degree for, that particular thing. A lot of it is how good are you at training your staff? So you bring people in that have the right personality profile, a good mix of the personality that, is, if you need somebody who's detail oriented, I'm not trying to get somebody who's not detail oriented to do that. You want somebody that's good with customers. So I want them to be accommodating. I want them to have some outgoing, some gregariousness to them that they can work with the public. They're not shy and don't know how to talk to people. And so the idea is I can take those people, but really the more that I can catch somebody on the early end of their pay cycle and grow them and where it's kind of like where we say their pay is chasing their performance. So the idea is I want performance to increase and the pay to catch up to it. I don't want it the other way around that I have to pay them something and then coerce them into performing up to that number. The only time that should happen is when I first hire somebody because they're an unknown. I have this hope of what they're going to do. And in that case, I've got to pay them a number and coach them into performance. And really, I got to get that performance above their pay, and then they start moving up. And too often.
So you talk about that in the book, though, Greg. You talk about this cycle of saying you could hire somebody that's new, kind of has a mid-level experience, or somebody that's very, very experienced. This relates to the metaphor that you use about the NFL and salary caps, which is really insightful. Could you share that real quick?
Yeah. So the idea of the salary cap is this. So we can take a business at your current run rate and actually back into. We think every business has a natural salary cap at the level that you're doing. Because if you really strip a business down to its core, here's my revenue that's coming in. Here's my operating expenses other than labor. I guarantee you there's not a lot of mystery in those. If you really look at those on a rolling 12 basis, they're not changing much. The only number that's changing is labor. And so really, if I get down to that number and say, well, once I know my revenue, once I know my non-labor cost, here's my target profitability. By default, I'm backing into an overall labor number. It's a mixture of management and direct. And then I get to use a strategy because not every business is exactly the same. I can have some people in management in my business that other people don't have, and I put that requirement on my direct labor, and vice versa. So I can mix and mingle, because if you think about it, there's a good simple philosophy in labor productivity management. A higher paid person theoretically should be able to self-manage them to a large degree with really just some leadership and probably longer term management, goal setting, and those things. Whereas a lower paid person needs more active day-to-day, task-to-task management. And so if I have a lower paid person, I got to have more management structure to support that person. If I have a higher paid person, I should have less of a management structure. So, I mean, in our business, we have a much lower direct labor efficiency ratio because we generally have fairly decent, some of our young folks, they still need to be coached up, but for the most part, our team does a pretty good job of self-managing. You give them a list of tasks and they sequentially go through and knock them out. But the higher paid a person is, the more self-managing that they are. And I think that's almost commonly true. Now, if you find that you got a high-paid person that you got to manage, I'd be scratching my head going, I may not have the right person there. And so that theory kind of holds true. And so think of it like an NFL team. An NFL team, every NFL team pays exactly the same amount of wages. Well, why is it that the New England Patriots, love them or hate them, have been to the playoffs 17 out of the last 19 years, and the Oakland Raiders hadn't seen the playoffs in the last 20 years? But they both paid exactly the same amount of wages. I mean, that's just awful. I mean, and there's no excuse for that except it's management. Management chose the players. Management coaches the players.
Right.
But they all have access to the same pool of players. And let's face it, the Patriots have traditionally drafted at the low end of the draft for those 20 years as well. And Oakland's been up there in the top 5 to 10. And so they should be getting a much newer access to the crop of college players coming out. And so, so there again, I mean, every business is like that. And so the idea is we get to take that labor pool that we have of our salary cap and say, what play are we going to run? Are we going to be a passing team? We're going to be a running team? We're going to be a balanced attack? Do we want to be a more dominant defensive team and have an okay offense? So I get to take that labor budget and really make it fit my strategy. And if I have a labor budget that doesn't fit my strategy, then I'm not going to make a profit.
So with that NFL metaphor, though, kind of the last piece on that, though, is run, defense. Yes, that definitely matters. But with the Patriots, what you mentioned in the book is that in using the same amount of dollars and pulling from the same talent pool, they strategically prioritize players that are earlier in their life cycle and talent development cycle, which is a direct analog to small businesses. Do you hire the superstar or do you hire early on and train into the role?
Absolutely. And the story was Lawyer Malloy. He was a Pro Bowl free safety, healthy, market value of $4 million a year. His contract was up, and they just drafted a rookie in the first round, Eugene Wilson out of Illinois, and had signed him to a 4-year rookie contract that all the same, $400,000 a year for 4 years. And so they're sitting in a player development meeting, and Belichick says, or the team president asked Belichick, he says, well, what do you think? I mean, should we re-sign Lawyer? He says, well, Lawyer's a great player. I mean, we know he's a known commodity, but I think I can coach this kid up to be 60% as good. And I think this is the kernel of just wisdom that him saying that. He didn't expect him to be as good. He said, I can be profitable at 60% as good. And so it gives me $3.6 million of more money to spread around to the other people I want to keep. That's brilliant. And so they cut Laurie Malloy. He goes to the Buffalo Bills, never to be heard from again. And sorry if there's any Bills fans on the call. And then Eugene Wilson becomes a Pro Bowl player. You know what happened to Eugene Wilson after the end of his 4-year contract?
What's that? He got cut?
He didn't get cut. He became a free agent, and he goes to play for the Houston Texans, never to be heard from again.
So the point is that it's a team philosophy.
It's a team philosophy.
Rather than on a one-on-one basis, it's not a human worth sort of thing. It's for the team, for all the players, for everybody to benefit. Let's take a philosophy that's maybe a little bit more nuanced than I like Joe. We have a great interpersonal relationship. He's a hard worker. It's bigger than that.
Yeah, because if you think about team development, I mean, it's really one of those things that, if I pay the absolute top of the market, one, I don't think those people are going to get along. Two, I can't afford it because I won't be profitable. And so I'll go out of business. And I think people try to pay top of the market because they're just lazy in terms of player development. And so really the idea is I want to blend. I want to keep my long-term team in place, and that's great. And I think this establishing this fairness doctrine of saying, listen, you give me market performance, I'll give you market pay. Let's keep doing that as long as it works for both of us. Once I have a person who wants to maximize their compensation, and we talk about this quite often. So when we pull a salary survey, you get here's the bottom 10%, which nobody ever will be there. Here's the median of the pay band, and here's the 90th percentile. And I tell people constantly, I do not want anybody on my team that I'm paying at the 90th percentile, because that's the foolish people overpaying people. Now, I may want to be there as an employee, but I'm not going to be a very good team player, because I'm leaving no resources left for the team to be a sustainable business. I mean,
it's not your recruitment philosophy.
No, not in the least.
Totally makes sense. So let's just transition here to some questions. I'm fascinated. I'm getting educated. I have a ton to learn in this area. Really fascinating stuff. Guys, you can input questions down below at the bottom of your screen. There's a place to enter questions. We'll go through some of these. Greg, the first one in the list is, do you suggest introducing performance-based compensation? And obviously the answer to some degree is yes, but I think that the nuance of this question is should that be directly connected to specific outputs, or should that just be like big picture overall labor efficiency type angle?
Yeah, so this is a common thing. So in my book, I wrote about this thing. I was getting frustrated with a client who kept trying to do all these kind of incentive plans, and it really dawned on me that what the entrepreneur's classic reaction to incentive pay is, they're trying to abdicate leadership and management by saying, if I give you the right money, you'll do all the things I want you to do naturally. Well, that doesn't happen in real life. I'm sorry. As a matter of fact, if anything, it causes unintended consequences. And so I'm far more in the camp of the Dan Pinks and the Adam Grants of the world that talk about, I think, like in sales, paying somebody a salary is a perfectly fine thing. I'm more in the camp of, if I do variable compensation, I'm fine with a great game of business concept of giving somebody a market-based base pay, and then they can earn, rank and file generally would earn up to 10% of their base pay for the company to hit their target performance, and then management would get around 15%. So if you look at Springfield Remanufacturing, who developed the great game of business concept, fundamentally that's their targets that they use, and we have a model that we use to calculate those targets. So because the idea is, if I establish the critical number, what we call contribution margin, and we don't have enough time to define that today, but we believe there's a number that's in the middle of the P&L that is contribution margin, and we think that's the cleanest number to base any variable pay concept off of, because I don't want to base it off a net profit, because I get discretion as an owner as to what I use profit for. And I don't want to create a conflict between the people that are producing the engine of my business with the people that are supporting that engine. And so, because most of them don't have any discretion over those items anyway.
Sure.
I want them producing that productive element of the business. And so once we base it off of that contribution margin attainment, if you tell me contribution margin dollars, I can predict revenue and I can predict net profit off of that one number based on patterns of the business. So it's real easy. It's a real solid number to base it off of. And so what happens is, and I feel like I'm a pretty smart guy, but I'm not smart enough to figure transaction to transaction compensation. I think that's where people get lazy, and you throw a number out there, and I'm essentially giving somebody an annuity off of some action. And And invariably, I cause them to focus on actions that may not always be in my best interest or their best interest.
So it's over-engineering things.
Over-engineering, yeah. So what we like is this idea of saying, listen, Here's what I need you to do across a year's worth of time. I'm a big believer in yearly analysis. Even if I'm giving somebody a 6-month review, I'm looking at the last 12 months of their performance, not the last 6 months. That rolling 12, whether it's the P&L or your personal performance or whatever, that rolling 12 is the most valid number because it's got all the holidays, all the seasons, all the variability has been taken out of it. And to me, that's where all the analysis should come into. On a perfect basis, when we look at compensation, there's really 3 things that you got to look at. One is, has the market moved for what that person does? Because that creates pressure on my model, which forces me to really make a hard decision and raise prices sometimes. And you just kind of have to do it. But usually we don't raise prices fast enough. We usually wait until we have wage pressure, and then we're forced to raise prices. And you really ought to be always constantly rethinking those. So that's one thing. The second thing is, once market moves, then I'm evaluating that person and say, well, have they moved up a level? Are they doing more now? And is their personal performance? And then, or they had some exceptional performance, but it's not sustainable. Well, then I just want to look at that reasonably and go, well, that person's probably doing a bonus. Let me recognize that, but tell them, says, hey, I'm not convinced that you can sustain this and make it happen all the time. So let's just go ahead and pay you a bonus. And so then, if you then end up doing the gain sharing piece of the 10% to 15% bonus at Springfield Remanufacturing, over the last 30 years, they've averaged, even though the target is at 10%, the model is built to where it doesn't cap at 10. It'll go up. It'll keep going up. They've averaged a 13% attainment for the rank and file because they've constantly beat the target, and they've averaged 18% for management. And that's as far as I personally recommend. Now, we manage a lot of incentive pay systems for clients who they just believe in that. And I will give you the option that if the market that you're in just requires that, and for you to be competitive with a person, if everybody in that market is paid on a variable basis and you got to compete that same way, okay, I get it. I'll live with that. But the human behavior aspect of things do not indicate that gets you the best result.
Very much makes sense. We have another question from Steve Welty. The question is, how do you account for creative work as far as pay scale, improving systems, innovating, self-managing, pushing lower skill tasks to VAs? I traditionally pay people more when they work on the business rather than doing just what is expected in the business role. It's harder to measure output for this. Can you please speak to this idea?
Yeah. Well, the easy way to measure that output is as we talked about, the contribution margin number. So in a traditional business, let me take the construction company example. So contribution margin is revenue minus direct costs gets you to gross margin. Gross margin minus direct labor gets you to contribution margin. So that is what we call the pure output of the business engine. And so in that particular case, when there's more contribution margin dollars for what management is helping promote, that's how you know that you can feel good about, oh, we did this system. Well, great. Did it move any dollars? I mean, you may feel better about it, and that's great, but I want to see dollars in performance. And so if I can get that that number, that's the truth that tells me. And so what we do is we look at these dollar movements to confirm what you see with your eyes. So you saw that person doing those things that I totally agree with you. But there again, this kind of goes back to where, Michael Gerber gave entrepreneurs scissors to run with, because he put out the E-Myth, and he gave us this phrase that I hear every stinking day. Oh, I need to work on the business, not in the business. Well, if you're a $100 million business, that may be true. But I got some working in the business to do every day too, and we're not a small business. So
it's a great ideal, but not always practical.
Exactly. So I've got to, if I have working in the business responsibilities, I got to take care of that too. And I have to be a wise manager to balance the two.
Really, really interesting. How does that relate to what percentage of companies do you deal with that are effectively lifestyle businesses as opposed to businesses that are very much focused on scale and growth? Like, what's the mix of your clients? Do you deal with any lifestyle type businesses?
we deal with a few, but they have a tendency that, once we get them fixed, they kind of settle into probably more of the minimum structure of, a very light consulting agreement, and then we're doing tax management. But here's, I'll give you a good example. So we had a client that was a government contractor, and it was a husband and wife. They had no facility. Everybody was remote. They were doing $800,000 of annual revenue and $600,000 in profit between their salary and their profits of the business. And they were saying, well, we're thinking we want to try to grow to $3 million. And I go, why? I said, you'll make less money. I mean, so now roll that forward. So they're still a client today. And so they did do some other things, but what they did, and this goes back to that return on investment, they took those profits and decided to do some different things with them. Because understand this matrix of taking capital. If I take capital and invest it in a productive business, I said at the beginning of the presentation, I want to make 50 to 100% return on that, right? So that's what the opportunity is. He's about to close a $12 million sale of some software that, because he had profits from the other business, he was able to spend time to develop this new software process that they've now got a big, large company that wants to buy out that software, and for, I mean, a really nice number, and so that's that thing of, as we infuse them with these ideas of how to take profits and turn them into leverageable, greater wealth building. I mean, some will do it. Some just want to be a good consumer. Like, well, we need both. So you get to, the entrepreneur has to design their own destiny of where we're trying to aim at. Ours is to make sure that they don't make stupid decisions that are inconsistent with that design.
Sure. So it's not about placing a value judgment one way or the other. It's just saying, let's intelligently pursue whatever strategy we're going after. So, guys, we're going to go ahead and wrap things there. We will be sharing Greg's slides after the fact. Didn't use them, didn't need them. Greg is amazing without the slides. If you are interested in hearing more about Greg's philosophy and getting more of a personal application to your business, consider the mastermind, the property management mastermind that we are doing via PM Grow in July. There's a link down below the video where it says mastermind application. If you're interested in that, check it out. It's going to be a group of some really solid property management entrepreneurs. Greg is going to be there in person. Greg will be gathering financials for each of the participants ahead of time, formatting those, and doing analysis in depth while we are there. I'm super excited about that. It's going to be a massive opportunity. We're hearing a lot of high-level principles, but it's different to actually have that applied to individual businesses on a P&L to P&L type level. So we're super excited about that, Greg, and we really appreciate you taking the time to join us out there.
Well, we really look forward. Anytime we can get a group of entrepreneurs together that are open and share their data, it is the most robust learning experience that we participate in. And it takes a special person who's willing to put it all out there and deal with financial truth. But I'll tell you, everybody that we've done this with, when we do this group sharing process, they just see phenomenal results.
Fantastic. We're looking forward to it. Check out that application, mastermind application down below. July, it's in Puerto Vallarta. It's an amazing venue, amazing group of people. Very exciting. Greg, thank you for your time today. Guys, if you haven't got the book, go get the book. Where's the best place for folks to get a copy? On Amazon?
Just go to Amazon. Yeah, Simple Number. If you just Google or just put in search Simple Numbers, it's an easy search term. They find me pretty quick. Between Simple Numbers and Crabtree, you can't miss me.
Great book. I've read it. It's been huge food for thought for us. So go get a copy. Greg, thank you again. We'll see you in July.
All right, appreciate it. I look forward to it.
All right.